In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation.
So this is an emergency update about what just happened at the Federal Reserve yesterday, December 10th, 2025. And I need you to understand something crucial right now. The Fed did not just cut interest rates. They made several admissions that should have everyone paying very close attention to what is coming next. And I am not talking about the rate cut itself. I am talking about what they said between the lines, the warnings they are giving us about the labor market, and the absolutely unprecedented situation they are dealing with right now. Let me start with the big one. The Federal Reserve just admitted that the official employment numbers we have been seeing might be lying to us. Not in a conspiracy theory way, but in a very real, very measurable way. During his press conference, Chair Jerome Powell said something shocking. He said the Fed believes that official payroll figures are overstating job growth by roughly 60,000 jobs per month. Think about that for a second. Every month when we get those employment numbers, we might need to subtract 60,000 jobs just to get to the truth. That means job creation might already be negative. We are not just slowing down. We might already be losing jobs, but the official data has not caught up yet. Now, why is the Fed saying this? Because they are seeing something in the labor market that the official statistics are not capturing. Powell described the current economy as very unusual, and he kept emphasizing that downside risks to employment have risen in recent months. The unemployment rate is still at 4.4%, which sounds decent, but that is only because the supply of workers is shrinking. Immigration policies have reduced the pool of available workers, and there has been a wave of retirements. So the unemployment rate stays stable, but underneath that surface, the labor market is actually getting much weaker than it appears. The data we do have is pretty grim when you look at it closely. Through November 2025, employers announced over 1.1 million layoffs. That is the highest level since 2020, the pandemic year. Job openings are fading fast. The ADP Private Jobs Report showed a surprise drop of 32,000 roles in November. Challenger, Gray, and Christmas reported that year-to-date job cuts through November reached 1,170,821 positions, up 54% from the previous year. These are pandemic-level numbers showing up in an economy that is supposed to be doing fine. And the most concerning part is what Powell said about hiring. He noted that both layoffs and hiring remain low. This is what economists call a low hire, low fire labor market. Companies are not mass firing people yet, but they have also stopped hiring. And when you are a recent graduate looking for your first job, or you have been laid off and need to find something new, that is a disaster. You are entering a market where nobody is hiring. The Fed is clearly worried that one wrong move could tip this fragile labor market over the edge into something much worse. Now, before we get to the second terrifying admission, let me say this. If you are finding this information valuable and you want to stay informed about what is really happening in the economy and markets, make sure you hit that subscribe button. This channel is all about breaking down complex economic news into something you can actually use. And trust me, you are going to want to follow along because what happens next could affect every dollar in your portfolio. The second terrifying thing the Fed admitted is that they are caught in an impossible situation. Powell kept repeating this phrase, there is no risk-free path. What he means is that the Fed is stuck between two terrible options, and whatever they choose, something bad is going to happen. On one side, they have inflation that remains elevated, particularly because of tariffs. On the other side, they have a labor market that is showing serious signs of weakness. The Fed stated that in the near term, risks to inflation are tilted to the upside, while risks to employment are tilted to the downside, calling it a challenging situation. This is about as rare as it gets. Usually, the Fed can focus on one problem. Either inflation is too high and they need to cool the economy, or unemployment is too high and they need to stimulate it. But right now, both problems exist at the same time, and they are pulling in opposite directions. The inflation problem is not going away because of tariffs. Powell explained that if you exclude tariffs, inflation would be in the low twos, meaning tariffs are causing most of the inflation overshoot. Research from the Street Lewis Fed shows that tariffs have been adding roughly 0.4 to 0.5 percentage points to core inflation. These price increases from tariffs are working their way through the supply chain, hitting goods prices particularly hard. Powell said goods inflation should peak in the first quarter of 2026, but that is assuming no new tariff announcements come out, which is a big assumption given the political climate. The Fed's own projections show inflation finishing 2025 at 2.9% and then easing to 2.4% by the end of 2026. That is still above their 2% target. And the longer inflation stays elevated, the more risk there is that people's expectations about future inflation start to change. That is what the Fed is most worried about. If people start to believe that 3% inflation is the new normal, it becomes a self-fulfilling prophecy. Companies raise prices, expecting inflation. Workers demand higher wages, expecting inflation. And suddenly, 3% becomes locked in. But if they raise rates to fight inflation, they risk pushing the already fragile labor market into outright job losses. And if they cut rates too aggressively to support jobs, they risk letting inflation expectations drift higher and losing control of price stability. That is why Powell said there is no risk-free path. Whatever they do, they are choosing which mandate to prioritize. And right now, both are threatened. The third admission is perhaps the most technical, but potentially the most significant for what is coming in 2026. The Fed announced that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. Now, if your eyes just glazed over, stay with me because this matters. The Federal Reserve will begin buying $40 billion of Treasury bills per month starting Friday, December 12th, in a move to ease short-term funding costs by rebuilding reserves in the financial system. Why does this matter? Because when the Fed ends quantitative tightening and starts buying securities again, it usually means they are seeing signs that something, somewhere in the financial system is starting to show stress. The Fed had been shrinking its balance sheet since 2022, letting bonds mature without replacing them. This process, called quantitative tightening, or QT, drained liquidity from the system. The balance sheet went from $9 trillion down to $6.6 trillion. But in recent months, money markets started flashing warning signals. Key money market rates began drifting higher, and financial firms started heavily using the Fed's standing repo facility, which is basically an emergency overnight lending window. The Fed is saying this is just normal reserve management to maintain adequate liquidity. Powell explained that they need to accommodate projected trend growth and demand for Federal Reserve liabilities and handle seasonal fluctuations like the April 15th tax deadline. But investors are not entirely buying that explanation. When the Fed suddenly needs to inject $40 billion in Treasury purchases right away, with Powell admitting that purchases will remain elevated for a few months, it suggests the situation is more urgent than they are letting on. And there is another layer to this. The Fed only resumed buying securities after ending QT just last month, in December. That is an incredibly fast pivot. They usually give these things time to play out before reversing course. The speed of this decision suggests they saw something in overnight funding markets that made them concerned enough to act immediately. Now, let us talk about the fourth terrifying admission, which is really more about what is being left unsaid. The Fed is deeply divided right now. The rate cut passed with a 9-3 vote, with 3 dissents, an unusually high number reflecting sharp disagreement among Fed officials. One official wanted a larger half-point cut. 2 others wanted no cut at all. And Powell mentioned there were 6 soft dissents, where officials voted for the decision, but their personal projections suggested they actually preferred something different. This level of division is rare. It reflects the fact that even the experts inside the Fed cannot agree on what is the right move because the data is pointing in so many different directions. Some officials think the labor market risks are severe enough that they need to cut rates aggressively. Others think inflation risks mean they should hold steady or even prepare to raise rates if necessary. This disagreement is going to get worse, not better, because of what is happening with Fed leadership. Powell's term as Fed chair ends in May 2026. President Trump has made it clear he plans to replace Powell, and the overwhelming frontrunner right now is Kevin Hassett, Trump's National Economic Council director. Prediction market Kalshi put the odds of Hassett being nominated at 86%. This creates what Treasury Secretary Scott Bessent earlier this year called a shadow chair situation. Once Trump announces his pick, which could happen before Christmas, that person's views will start influencing market expectations even before they officially take over. Hassett has been very public about believing rates should be much lower. He stated on Fox News on November 20th that he would be cutting rates right now if he were the Fed chair because the data suggests that we should. Right before the Fed meeting, Hassett told reporters he would vote for a half-point cut if he were at the table. That is double what the Fed actually did. The concern among economists and market participants is about Fed independence. The Federal Reserve is supposed to make decisions based on economic data and their dual mandate, not based on political pressure or what the president wants. But if Hassett gets the job, he would be the closest to a sitting president that any Fed chair has been in modern times. Markets have already reacted, with long-term rates rising amid concerns about potential political interference in monetary policy. Some analysts are drawing parallels to the 1970s relationship between President Nixon and Fed Chair Arthur Burns. That partnership led to the Fed keeping rates too low for too long, which eventually resulted in the devastating inflation of the late 1970s and early 1980s. Burns ultimately faced rebellion within the ranks of the Fed, and given how much dissent we are already seeing in voting patterns, a similar dynamic could emerge. The Fed's own projections tell a concerning story. According to their dot plot, they are forecasting just one more rate cut in 2026 and another in 2027. But markets do not believe them. Market pricing suggests roughly 2 cuts next year. This disconnect between what the Fed is saying and what markets expect creates its own problems. If the Fed ends up cutting more than projected because the labor market deteriorates faster than expected, it signals something has gone wrong. And if they do not cut despite labor market weakness, it means they are prioritizing inflation control over jobs. Powell tried to position the Fed's current stance as being in a comfortable place. He said they are now well positioned to wait and see how the economy evolves. The language in their statement about carefully assessing incoming data and the extent and timing of additional adjustments is Fed speak for "we are" on hold. When they used similar language back in December 2024, it signaled they were done cutting for a while. And indeed, they did not cut again until September 2025. But can they really afford to sit still? The labor market weakness they are acknowledging suggests that waiting too long could be a mistake. Top economist Claudia Sahm told Fortune that if the Fed waits to cut until they see clear deterioration in employment, they have already waited too long. Jobless claims are still low, but they are a lagging indicator. They typically spike only after a recession has already begun. This creates a terrible dynamic. If the Fed has to continue cutting aggressively into 2026, that will not be good news. It will mean the labor market situation has gotten worse than expected. But if they do not cut and unemployment rises, they will be criticized for being behind the curve and letting unnecessary job losses happen. They are in a no-win situation. The fifth and final terrifying admission is about what this all means for the broader economy and your money. The Fed is essentially telling us that the economic expansion we have been enjoying is now running on fumes. Yes, GDP growth is expected to be around 2.3% in 2026, according to their projections. But that growth is being driven almost entirely by high-income households. Powell acknowledged that higher-income households backed by home equity and stock market wealth are driving spending, while lower-income consumers struggle with accumulated price increases. This is what economists call a K-shaped economy. The top is doing great. They have assets that have appreciated. They have good jobs. They are still spending. But the bottom half is struggling with the fact that prices are significantly higher than they were 5 years ago. The inflation rate might have come down, but price levels have not. When you go to the grocery store, things still cost 20 to 25% more than they did in 2020. When you pay rent, it is dramatically higher. For families living paycheck to paycheck, this is crushing. And if the labor market continues to weaken, those lower income households will be hit first. They will be the ones facing layoffs. They will be the ones who cannot find new jobs in this low hiring environment. Consumer spending, which drives about 70% of the United States economy, will start to crack. And once that happens, the slowdown can accelerate quickly. The Fed is trying to engineer a soft landing, where inflation comes down without causing a recession. But the reality is, they might not have much control over what happens next. Tariff policy is being set by the White House, not the Fed. Immigration policy affects labor supply, and that is also outside Fed control. Global trade dynamics and how other countries respond to United States tariffs will play a huge role. The Fed can only control interest rates, and right now, that tool seems inadequate for the problems they are facing. So what does all this mean for you personally? First, understand that volatility is likely to increase. Markets hate uncertainty, and everything I have just laid out is dripping with uncertainty. The Fed does not know what is going to happen. They are admitting they are stuck in an impossible position. Political interference in monetary policy is likely to increase with the new Fed chair. And the data we are getting might not even be reliable. Second, if you have a job, appreciate it and consider how secure your position really is. We are in a low hiring environment where finding a new job is much harder than it has been. Update your resume, build your network. Make yourself as valuable as possible to your employer. If you have been thinking about switching jobs, understand that the window for doing so might be closing. Third, if you are investing, this environment favors diversification and defensive positioning. I am not saying sell everything and hide in cash, but this is not the time to be making aggressive bets. Dividend-paying stocks, high-quality bonds, and assets that do well in slower growth environments should be getting more attention in portfolios. Fourth, keep some extra cash on hand. If the labor market does deteriorate and unemployment rises, having an emergency fund becomes even more critical. Financial advisors typically recommend 3 to 6 months of expenses, but in this environment, leaning toward the upper end of that range makes sense. And finally, stay informed. The economic situation is evolving rapidly, and what was true last month might not be true today. The Fed's next meeting is in January, but with potential Fed chair announcements coming before Christmas and new economic data arriving constantly, things can change quickly. The Fed has admitted they are facing a labor market that might already be weakening more than official data shows. They have admitted they are stuck between controlling inflation and supporting employment with no good options. They have admitted the financial system needed an emergency injection of liquidity, and they have admitted through their internal divisions that they do not have consensus on the right path forward. These are not the kinds of admissions you hear from a central bank that is confident everything is under control. These are the admissions of a Fed that knows something bad might be coming and is trying to prepare us for it without causing panic. The question is whether they can navigate this impossible situation successfully or whether we are about to see something break in a major way. As always, I hope you found this valuable. Hit that like button if this helped you understand what is really happening, and I will see you in the next one with more updates as this situation continues to develop. Stay safe out there.